Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending May 14, 2021. So today I'll be doing a solo edition because Mr. Gignac was not able to be with us this morning. But I'll start with look at this week's markets at the close on a Thursday. So as you can see, a lot of red on the screen for bonds, for equities, for other markets. So the inflation figure that came out in the US on Wednesday morning is responsible for most of this turmoil, but we had the strong pullback on Wednesday, a rebound on Thursday. And as I'm recording this on Friday, markets are not open yet, but they are pointing to another green day. So we'll see where we end up when it's all said and done. But the universe index for bonds down 0.6% on the week, minus 1.5 for the long index. Year to date, we're back to minus 12% for the long bond index. For equities, down everywhere, minus 1.7 for the TSX, 2.8 for the S&P 500, 4.6 for the NASDAQ, minus 3.8 for emerging markets. So bad week all around. Year to date, still ahead in Canada, 10.8% and more 9% in Canadian dollars. After that, it's 5.2 for the S&P 500 when we bring everything back in Canadian dollars. Price of oil, sorry, the table is a bit wrong here, but $63.8. So that's down on the week. Canadian dollar lower, euro lower, gold lower. So you had a bit of a bid on the US dollar following the inflation figure. So we'll get to the inflation figures in a few minutes. Just before COVID, on the left, you see the cases are still headed in the right direction, so lower. On the right, you see that Canada is getting pretty close to the US now as a percentage of the share of population having received at least one dose of the vaccine. So 41 in the US, we're at 46. So the gap is closing, and there's even some possibility that through the summer months we move ahead of the US in Canada because our pace of vaccination is actually better than the US now, and we can move to that. So the US on the left, you see that the number of confirmed cases are down. They were at about 200,000 plus at the turn of the year. Now we're below 50,000. So vaccine is working. We're hearing new guidelines from the CDC in the US that those that are fully vaccinated could stop wearing masks inside and outside. So a very strong milestone there. But on the right, you see that the pace of vaccination, so the dark blue line on top on the right chart, it's moving down. So that's the pace, the percentage of the population that is vaccinated daily in the US. So the easy part is behind us now. It's the hard part. So those that are skeptical about the vaccine that we need to reach. So it's moving lower. But you see that in Europe, all of the other lines are for European countries. So it is accelerating in Europe right now. So very, very good. Very good news there because the European markets are cheap. We've had a double dip recession because they were more proactive with restrictions for due to new waves of COVID. But now that vaccination is accelerating, we should see a very good momentum catching up in Europe. So back to the US, credit card spending is bouncing back, and an acceleration in jobs creation is at our doors, according to many forecasts. So it's good to see that the consumer is starting to use credit again, and it's not that we're advocating the use of credit cards. It's just that people, the households in the US and elsewhere in the world, when economic conditions are good, well, they spend more and they borrow to spend. So that, as you can see, the balance of credit cards were much higher before the pandemic. People used the checks that came in and the fact that you can't really spend on the things that you did spend on during a pandemic to clean their credit slate. And now we expect a full rebound of that. So the savings rate is high. So people will be spending, will be using their credit cards again. So that's a very strong tailwind to the US economy. The US consumer by itself is so large that it would be the biggest country in the world if we just take its GDP. Well, the amount, the consumption, and they compare that to other countries' GDP. That's how large the U.S. consumer is. So if it's going well for consumers, it goes well for the global economy. On the right, you see that the employment recovery, well, we're on the verge of an acceleration as we are reopening through the summer months. So all of this is telling us that the economy should be doing pretty well going forward. And that should lead to inflation. So this is the story of the week. Inflation is speeding up in April, fastest pace since 2008 for headline inflation. If we look at the core inflation on the right, the monthly pace was the highest since 1982. So that's very, very strong. So the economy is doing well. We know that the base effects, because when you compare with what last year, in March and April, in the worst of the pandemic, prices were under pressure. So we know that the base effect counts for about 2.5 of the 4.2% on the total inflation that we had. So there's that, but we see that the monthly figures are accelerating, and this is what's concerning the markets right now, because the surprises for inflation on the left, whenever all of the little sticks that you see on the left, on the top is the CPI month over month figure. In the middle is the core CPI month over month, and in the bottom is the year over year inflation. So sometimes you have positive surprise, so that's red. Sometimes you have negative surprises, that's green. And you see that the surprise that we had in April was the biggest in a very long time. And on the right, you see that it was mostly about bottlenecks in sectors that are affected by the reopening of the economy. So hotels, auto rental, used autos, because people are planning that at some point maybe they'll need to go back to work. So in the office, not to work from home. So all of these sectors are pushing inflation much higher. So that leads us to the financial markets and to the Fed, that says, well, still thinks the inflation is temporary, sticking to its guns. There was even a comment, a funny comment from one of the regional Fed president that said that inflation will be as temporary as last year run on toilet paper. So this was his comment to show how convinced that they are that we will only see a temporary spike in prices. The argument that they're making is that, well, some people are making more money staying at home and getting the government support and going back to work. And when these programs end, well, they will be going back to work. So you won't really have a self-fulfilling cycle of wage pressure that will cause a higher expected inflation, which will cause more wage pressure and this kind of inflationary cycle. So this is what the Fed thinks. Let's see if they're right. Only time will tell. The market is saying, well, not quite convinced. On the left, you have the 10-year break-even rates. Now we're the highest since 2012. So this is what is expected in the market. So the market is seeing 2.56% inflation on average over the next 10 years. And on the right, it's just a shorter time frame. As you can see, it started accelerating in the last few weeks with all of these data coming in. So let's see who's right, but now the market is not convinced by the Fed as a story. Still, when we look as asset allocators to the state of the market, well, on the left, it's still equities over bonds. This is the equity risk premium, so the earnings yield minus the 10-year treasury yield on the left. So when the line is high, that means that stocks are more attractive than bonds. And when it's negative, when it's in the bottom, that means that stocks are less attractive than bonds. So even though we've had a very strong earnings season that pushed the price earnings to higher levels in the last few months, few quarters, even though we've had a strong return since last year, even though we're at an all-time high, the fact that interest rates are low means that we have still a stock market that is attractive compared to bonds. So that still pushes us to overweight equities, underweight bonds in our strategy. We are, of course, less overweight now than we were during the first year of the bull market that started in March of 2020. But we still stick to our guns that it's equities over bonds. And on the right, you see that the share buyback authorizations, they've surged so far. So after 4 months in 2021, the authorizations are way above what we've seen in the last 20 years. So another tailwind here for equities. So what to watch next week in Canada, housing starts, and we'll have our CPI inflation. So last month we had 2.2% year over year. We fully expect to have a figure of over 3% because of the base effects in April. So we'll see what kind of figure we get. And in the US, it's all about housing. So building permits, housing starts, and existing home sales will be published next week. So that wraps it up for the week. ia.ca/economy is your go-to web page if you want to stay informed. You can always subscribe to the newsletter if it's not done already. So thank you everyone for following us on a weekly basis, and we'll be back next week with another edition of the Weekly Economic Review.